Valerie Escobar, Senior Wealth Advisor with Mariner Wealth Advisors, and you are listening to Your Life Simplified. Today, I am with Brett Kunshek, Head of Options, and Brett is going to tell us all about the world of options. And so the first question I have is the most obvious that everybody wants to know. How do I get rich quick using options?
Well, first off, thanks for having me on this show today. And unfortunately, that's what most people think of options, right? Mm-hmm. With options, I would say the initial reaction of people that don't know much about them, but have heard some things about options, it's typically negative, right? Because usually you've heard the horror stories of people who have lost a lot of money and they just think of options from speculating. So it is. A lot of people think of, hey, get rich quick, gamble with options, mm-hmm. right? But that's where we come in. And we look at options in a completely different way. So we'll get into that, I'm sure.
Yeah.
But I think that is the key thing, looking at it from a wealth perspective versus, hey, this is a quick get rich quick scheme of gambling and try and make a quick buck.
Yeah. And I mean, I literally got, my mom sent me a YouTube video. She's like, it says it's really easy and I can make a lot of money. I was like, good grief. Like, I haven't taught you how to scan, use the scanner. I'm not going to, I'm one of the really nice things I think is that we have you and your team, because it's not something that you kind of can dabble in. I think it's like a full-time gig. You got to be looking and paying attention to what you're doing.
I mean, even advisors for that part, right? Like it's, there's a lot of nuances, a lot of knowledge, that really helps with options. It's not that somebody can't do it themselves. They can, but you're going to, learn along the way. Yeah. It's better if you don't have to learn along the way.
Right. Yeah.
And so here, Mariner has a lot of unique things about it, and having an option team is one of those. Because most RIAs, do not have an option team, probably don't even use options. If they do, they're typically outsourcing it. Mm-hmm. Or if they have somebody, it's maybe an investments person who is doing a lot of other duties. And options is just kind of a side thing.
Yeah.
So here, that's the nice thing. Mariner's dedicated the resources to have an options team. And that's all we do all day long is manage option strategies for our clients. And that's, it's grown over the years. I mean, we're to where we have 1.7 billion in assets just in options over, 2,300 accounts. Yeah. So it's a smaller piece of the greater organization, but it's, I think, a very unique piece that helps, especially that high net worth individual who's looking for something different.
Yeah, for sure. And so let's start really at the very beginning. Like, just give me the textbook definition of what an option is, and then tell me what it actually is.
Yeah. So an option, right? You have your basic assets, stocks, bonds, cash. Well, an option is just a derivative. It derives its value from another asset. And that can be a lot of different assets. We only use options based on individual stocks and ETFs. So, with options, the easiest way to think about it, it's just a way to readjust that risk reward structure, right? If you own a stock and the stock goes up $1, you made $1. It goes down $1, you lost $1. Here, we can rearrange that to maybe have, a lot more attractive parameters than just owning stocks outright. Mm-hmm. So that's really the beauty of it is, you can reconstruct it. Some people might call it financial engineering. Mm-hmm. That looked upon it negatively sometimes too, but you can financial engineer things in a way that, can get you more income, right? Mm-hmm. It can reduce downside risk. And that's what we're really looking to do.
Yeah. And I think that that's the part that's really interesting is that, like you said, it tends to be viewed as really risky, but that risk mitigation piece, tell me more about that. How does your team use it too?
Yeah. In fact, most people think, I would say have an initial negative connotation with options, right? And they can be really risky. Just like you can buy a little penny stock, right?
Right.
And you can buy a crazy bond, right? Mm-hmm. A crazy junk bond. So you can do it with any asset class, and it really runs the risk spectrum. You can do very risky things, and you can do very conservative things, and everything in between. But how we look at it, again, it's from a wealth perspective. So there's three main objectives. There is income generation, risk mitigation, and then return enhancement. Mm-hmm. So those are all three ways to, create that better outcome. So a lot of people think of options more, like you said, from, just making that quick buck or, getting what's called, not to get too technical, but the volatility risk premium in really quick trades. Mm-hmm. We look at them more to achieve clients' objectives. How can we use options to better achieve clients' objectives? Some clients, you can get them there with just a more simplistic portfolio of stocks, bonds, cash. We look at it of saying, hey, if that doesn't get them there, how can we use options to get them to meet their objectives?
Yeah. And so one really common thing that I run into with a lot of clients that I use your team for is that a client will come in, they have a huge concentration of a stock. Either maybe it has a low stock, maybe it has a low cost basis, maybe not, but either way, it's a big risk to have that. So, tell me a little bit about the best way that strategies that we use to help reduce that concentrated risk.
Yeah. So concentrated positions, it's really a conundrum for advisors, right? Because a lot of times they do have a low cost basis. So the client isn't necessarily just wanting to blow out of it. That's the easy way. Just sell it and get diversified.
Right.
Well, it's not always that simple, right? And so if you can't do that, then what do you do? Well, there's different option strategies that we can do to, tactically get out of it over time while controlling that tax hit and also create an income stream. That would be called covered calls, right? So if that stock is trading at $100, we could go start selling calls at say 110 and receive a dollar or $2 per share. You get that income and you're waiting for it to go higher. Once it goes higher, we'll sell out of that stock at those higher prices according to our plan and control those taxes. And then the advisor would get the client, more into a more diversified portfolio. That's just, one example on how to tactically get out of it. You can also protect on the downside, right? We have income generation and then also risk mitigation. That's on a lot of people's mind, right? I have this big position, man, if it gets cut in half, I'm going to be in a bad spot.
Right.
So what do we do there? Well, kind of the same thing. We can sell that call, but instead of the client keeping that money, we can use that premium to go buy a put. And that's called the collar strategy. So the collar, hence you're putting a ceiling on the top and a floor on the bottom, and you can protect, really on that downside for the stock. So again, it goes back to achieving those objectives and using options, even on a concentrated position to, hey, how can we eventually transition this into a more diversified portfolio?
Right. Because our clients don't, or at least for me, I don't have a problem with the client's stock doubling in price. That's totally fine. Really, it's the fear of it being halved and that they're going to lose a significant amount of their wealth if it drops. And so I really like that, that's insurance. It costs money, right? And so you're able to create a payment to pay for that insurance by selling on the outside. And I want to get more into that, but first let's talk more about the income. If let's say there's not necessarily a concentrated position, but so a client just is like, how do I get a little bit of extra income?
Yes, we have a lot of different strategies to generate income. Kind of the most basic, widely accepted strategy by pretty much all advisors is the covered call, right? And that's where you own the stock and you're selling calls. And you can take what's maybe a 2-3% dividend yield to even get that total yield up to say 5 to 7. So you can really get a lot more income on that. And we run a couple, diversified covered call strategies with stocks. So there's several different ways to do it. Going back to the concentrated positions though, some people view covered call because they think there's no risk, right? Oh, hey, it goes up. The worst thing happens, I sell out at a gain. If it stays or goes down, the stock went down, but my call just expires worthless and I keep that premium. Well, the issue can be on these concentrated positions is it really runs up and calls were written on it, but the client doesn't want to sell. Right. So then that becomes an issue because, okay, now we have to buy this call back for a loss. That's creating a negative cash flow, not a positive cash flow. And now the exact opposite is happening that, we intended to do. So that's why we really limit it. We don't sell calls on positions that a client doesn't want to sell out over the next 2 to 3 years. We do that as just a long-term hold. Hey, that's a long-term hold that and just keep it forever if that's what you want to do. But this portion that we're looking to get out of, over the next 2 to 3 years, now we can put a covered call program around that or whatever option strategy it may be.
Right. And I think that's super important is because sometimes a client comes to us and they're afraid of losing. And then all of a sudden the stock is going up and now they're afraid of selling, and they're like, oh, this thing's going to keep going and I don't want to get rid of it. And so when you sell a call, you have to honor that call if it gets to the price that you promise to sell at, right?
Yeah. So we do actively manage everything we do.
Okay.
So, a lot of times there are moves we can make, meaning we could exit that call we sold and move it to a higher strike price. But if something's really running, there's only so many moves you can make. So at the end of the day, you really do have to be willing to sell. And that's why we take that more conservative route and saying, hey, we don't want to do this on positions that the client never ever wants to sell. I've seen it go bad too many times. Not here. A lot of times these accounts have, we've taken over from outside firms, but they said, hey, you can get a lot of income on this. And one of our larger clients, they had an outside advisor who was selling calls on Apple, right? It always tends to be Apple. Always tends to be like the greatest stock ever.
Right.
And so, but he never wanted to sell his position.
Oh.
And this was on 10 million of Apple.
Oh my goodness.
What's Apple do? Does what Apple does.
Yeah.
Really runs up. We ended up getting him out of it, but it was very painful. And it, ended up costing $800,000-900,000 to get out of that. So that's where a covered call can go wrong. But that's why we set it up in a way to where we don't, we create a very high probability of never getting in that type of situation.
Right. And so we were talking about, let's say we covered risk mitigation and income. What was that third piece?
So return enhancement. So we have a strategy called premium income. And this strategy is a strategy that we actually use quite a bit for clients who never, ever want to sell, but they're looking to say, hey, what else can I do to get more return? Whether it's on that concentrated position that they don't want to sell. We say, hey, well, covered call is not ideal because you never, ever want to sell. So but they're still looking to get a little more return. So our premium income strategy is a strategy you can overlay on top of a portfolio and add incremental return while keeping your portfolio exactly the same. So there isn't that sell decision. Hey, I have to sell asset A, B, or C to go into premium income. So that really, again, enhances the return of the total portfolio. Now it adds a little bit of risk. So it's for clients who have a moderate to aggressive risk tolerance, but that's, an example of a return enhancement type of strategy.
Okay. And so when it's for, like you said, it's for more aggressive investors. And so what could go wrong, in what market environment would they not see the kind of returns they were hoping?
Yeah, that type of strategy, it works well in most environments. The market's going up, works great. Sideways works great. Even going down, like a no good, awful year like this year, right? Bonds down 14% through September. Stocks down 20 plus. When doesn't it work? Well, it doesn't work in that crash scenario. What crash all comes to mind? February, March of 2020. So that's the type of scenario where we had to make a lot of moves to work through that. And we incurred a lot of losses, primarily mark-to-market losses, but it was a much bigger drawdown than the strategy's ever seen because we had a generational type of crash. We went to right. So that's the risk. But that's the other key thing is I always tell clients who are looking to get into that strategy is there's two main questions. One, do you like the strategy? And then if you do, two, what's the right size, right? Because again, it adds additional risk, but also additional return. So you don't want to get carried away with it, but you want to do enough to where it moves the needle, right? You don't want to do such a little amount to where, oh yeah, it made me a few bucks, but it didn't really do anything for me.
Right.
So that's where we work with the advisor to make sure we're looking to size that appropriately relative to their total investable assets.
Right. And so, market conditions that we have that black swan sudden crash type of thing that obviously creates not happy clients, maybe, hopefully they understood it going into it. But, what are other things perhaps that you see that clients are upset about or that they maybe didn't quite understand or, some frustrations that you've experienced?
Yeah, I think the key thing for everything is setting the expectations of how the strategy is going to perform in all different environments, right? And I think as long as you can educate the client up front and tell them, hey, in an up environment, here's how it's going to perform. Sideways, down, this is what you should expect. Nobody likes losing money at the end of the day, right? But if the strategy's down and then it's doing what it was built to do, then we honestly, even this year, we haven't gotten too many inquiries of, why does this happen? Was it because they're performing as expected and as the strategies were built? So that's really big on our part. And I think, again, that's why you want an options team, because I view 75-80% of my job is education and getting on calls every day with advisors and clients and prospects to explain the strategies, very thoroughly. What's the pros? What's the cons? How can this help you? How would this fit in your portfolio? And go through all those aspects.
Yeah. And I think maybe the one last question that I had, or one scenario that I ran into recently, is that we had put some calls on, a position, a number of shares. And then the client decided, oh, I forgot, I need to buy something and I really want to sell that amount of money. And there's already calls written on them.
Yep.
I mean, what do you do? What do you do in that situation?
Yeah. So we'll take a look at it and see where things are at. The reality is all the options we trade, they're all exchange traded. Okay. So they're very liquid. So just like going and buying an ETF or, large cap stock, we can enter into it and exit out of it really quickly. Now, it may be at a loss at that point in time, and it may not be an inopportune time to exit that position. But that's where we'll talk through it and say, hey, yeah, if you want to get out, we can definitely get them out that day. And that's with all our strategy. And that's the beauty of it, because it is an alternative. And a lot of people think of alternatives, it's kind of like real estate. You're locked in for at least a year, if not a few years or 5 years.
Right.
Here, in not all of our strategy, you're never locked in. You can exit at any time. So it does have that liquidity, but, depending on where the market's at, where the stocks have gone, that position may be at a gain or loss, or they may, want to wait until maybe that expiration's come. And so we say, hey, let's just let these options start rolling off if they're not in a hurry to liquidate. So that's where we work with the client and the advisor as well to really create the best exit strategy.
Perfect. Awesome. Well, thank you so much. This was great.
Thanks for having me on.
You've been listening to Your Life Simplified. Go ahead and subscribe wherever you are listening, and we hope to catch you soon.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP, registered trademark, certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.